We have with us, of course, Atlanta Fed President Raphael Bostic, who has provided the intellectual leadership for the region and has really been vocal recently about what's going to happen in September. And that's where we have to start. Where you said recently in a recent interview that it's a coin toss between 50 and 75 in terms of how many basis points you hike. What will determine that coin toss for you?
Well, for me, it'll be the data that comes in over the next couple of weeks. You know, PCE today is actually an important one, showing the economy is slowing down in an orderly way, which is helpful. But we also have a jobs report that's coming in, I guess, a week from now. And then 10 days later, we have the CPI. I think the three of those together will start to give me a sense of sort of the big story about how the economy is responding to our policies, and also just the changing dynamic. And if it comes in strong and starts strong, as if there's no change, I'll probably be leaning 75. If it comes in slowing like we've seen today, that's the first piece of evidence, I'll probably lean to 50.
Okay, so is there a certain threshold with the jobs data in particular that you're looking for? Because you mentioned that we saw a pretty elevated number the last time around. How is that going to inform you? What's sort of the cutoff that you're looking for there?
Well, I don't. These things. There is some art here, right? So it's not if it hits 277, then I'm good, right? I do think you have to think about this as, you know, what does the jobs number tell us in terms of trajectory? And the jobs, you know, the economy's been producing a lot of jobs on a monthly basis, 450 to 500,000 people a month, and that's a lot. I think we want to start to see that slow. And that would be consistent with the idea that our policies are starting to take demand and pull it down and reduce that imbalance that is underlying the inflation that we're seeing. So that's kind of what I'm looking for, and we'll look through it to see if there are particular sectors where there are movements that would suggest that there is some help that's coming in terms of the demand side.
There are thousands of traders on Wall Street who are turning blue now because they're holding their breath, waiting for the chairman's speech. And I'm wondering, given the disconnect that we've seen between Wall Street and the Fed and the fact that financial conditions have loosened, what's the message that you would like them to take away from the chairman's speech today?
Well, I think the message is inflation is high, inflation is too high, and we're going to do what we need to do to bring it down. And we're going to be resolute in our policy to make sure that inflation is well on its way to our 2% target. And I think that is the basic message. We've been saying that already, right? So that's not a new message, but it is important for us to be continuing to reinforce that so that there isn't uncertainty about what we're going to do. You know, we're still in a pandemic economy. I try to remind everybody that. And one of the things that's been true is that the unexpected has happened repeatedly. And so I would like for our policy, and I think my colleagues share this, to not be contributing to that uncertainty. We want people to understand sort of what our reaction function is and what we're trying to get to, and that we're not going to bounce around. We're going to be stable, resolute, and sure about where we want to be.
Well, are you willing in Wall Street parlance to be Volcker, to let the economy go into recession if you need to focus more on inflation, bringing that down because the costs are higher?
Well, you know, inflation is extremely high. Sort of unimaginable. The levels we're at were unimaginable 18 months ago. And so we have to get that under control. That's job one. That's our top priority. Beyond that, you know, if we start to see weakening in labor markets, but inflation is still too high, we've got to get inflation down. Like, that is the first thing. So I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today, right? There's a lot of momentum in terms of job creation, and so I'm going to focus on the next month and the month after that. And, you know, I think we won't have to face a question like that for quite some time.
Well, to put three questions together into one about the terminal rate, what do you think you need to get to? How fast do you need to get there? And then how long do you leave it there?
So that's three questions at once,
yeah,
right?
So you got to do it well.
And I'm supposed to do this in a short. I know we don't have 20 minutes. Right?
You've got 8 minutes to answer that.
Yeah,
if
so
you
go
want.
ahead.
Oh, then I got time.
Yeah.
Take your time.
Relax.
Right. So for me, I think I want to see our policy get to something that's marginally restrictive. I think right now we are still in a somewhat accommodative state weekly. So I'm looking for us to move maybe 100 basis points, maybe 125 basis points from where we are in terms of that movement. I'd like to get there sooner rather than later. I think that the sooner we get to that level, the faster and the more dramatic our impact will be on the economy. But I also want to do it in an orderly way. I want to get to that terminal rate in an orderly way so that the markets and businesses and families don't think that our movement is suggesting there's some underlying weakness or something unexpected that's going to make people be concerned. And then in terms of staying there, I think we should stay there for a long time. And I would say I want to see the signs of the economy slowing be clear, but also start to see inflation really moving down to closer to our 2% target before we contemplate sort of moving at all. So, the word I'm using a lot is resolute. I think once we get to that level, we want to be resolute in our goal, which is to get inflation down to our target.
I've got to ask this because you mentioned a time. You said a long time. What's a long time?
Oh, it could be 5 days. 4 months.
Precisely.
No.
You went there.
Come on.
I didn't ask the question. You went there.
Right. So for me, I think what my team has told me and what we've seen historically is that it takes a long time for the actual inflation numbers to move. The economy's got to weaken in a lot of ways. It's got to slow down. And on some level, the inflation number is the last number to move. And so where I am right now on this is, from a typical perspective, we would expect maybe 18 months, 2 years for that trajectory. But at the same time, if you look at how financial markets responded to our policy when we started moving in March, it moved much faster than we've seen historically. And we know that in the pandemic, the economy has evolved faster than we expected historically. GDP responded much faster than the analysts were expecting at the outset. So there is the possibility that the movement in inflation could be faster than what we've seen in the past. The reality is, we don't know what's going to happen.
We don't.
Right? And so I want people to know that we're really focused on the goal. And the goal is to see that inflation move. I'm hopeful it goes faster, but I can't say that for sure. So we're going to just have to wait and see.
I think what we all need then is not the crystal ball, it's just a deeper understanding of your reaction function. And we kind of danced around it just a little bit. Can you help me understand the following? If the mandate is in conflict at any point in the next 12 months, if inflation is still too sticky, but the growth side of things, the labour market starts moving in the wrong direction, do you need to tolerate that to get this lower? Is that something you're willing to tolerate?
Sure, we have to be open to that as a possibility. Look, if inflation is far from the target and labor markets and employment is relatively close to target or on target, some would say we already overshot the target, we should be willing, I would be willing, to see that those employment numbers moderate to get us either back to target if we've overshot or maybe a little further away from the target. But that further away right now is still extremely close. And so my concerns in terms of our mandate are not very heavily weighted on the labor market side, much more on inflation.
There's a belief that seems to be embedded in markets that we're going back to what we knew 10 years ago in terms of inflation being low, growth being slow, and that just sort of being the normalcy, and that rates will eventually go back to what they were accustomed to, say back then. Do you disagree with this? I mean, this is one of the fundamental questions. Are we in for a sea change in how much inflation there is globally and in the United States?
Well, I think that's an interesting question. I actually think it's an open question. If you think about what's happened through the pandemic, where we've discovered that supply chain strategies, where you're relying on just one supplier, increases exposure to volatility and outputs. Businesses are changing those strategies. The ones I talk to, they say, look, we're no longer going to rely on just one supplier, that lowest cost provider, and we're going to do this across a number of different suppliers. That, in and of itself, means we're going to have higher cost basis. There's going to be upward pressure on prices that we're going to have to embrace. And so there's a lot of other things that are going on in the economy, such that it's very difficult to project that. And so I would say, I think inflation is going to wind up being a little higher than what we've seen historically. How much higher, and is it going to be material? I think we're just going to have to let things play out to understand that.
So going back to John's question about how long, and you said, could be, typically it was 18
5
to 20
days.
minutes, 2 years, 18 to 20 minutes. Exactly, why don't we bring it down? 5 days, a month, or, it's been 18 to 2 years. Could it be much longer than that? Could it be that the new Fed funds rate eventually evolves to something closer to 3 to 3.5%? Is that something feasible? Not just could, but is it feasible in your framework?
Well, I think it's possible. But a lot's going to happen between now and when we get to that place to where I'll be able to have an understanding or a sense of whether that's a new permanent and whether there is some new kind of floor that we're going to have to push to. But I don't know that now. A thing that's been helpful, like conversations like this are actually quite helpful in making me be sensitive about what sorts of things we need to be focusing on, me and my team need to be focusing on as the economy evolves for the next couple of years. So I know they're watching this, so this will be something that shows up on their list of things to do over the next 6 to 12 months.
We've got about 90 seconds left. I want to squeeze this in because we had the discussion with President Bullard as well. Where does balance sheet reduction fit in? I get so many questions from Bloomberg subscribers about this almost every day. Why aren't we talking about this more? Why aren't we talking about this more? Where does it fit in?
Well, I think it fits in as an additional tool to policy, and the reduction of the balance sheet will have sort of a more restrictive impact on how the economy evolves. We are very early on in the reduction of our balance sheet, and we're still ramping up in some regards to get to a level of that we can start to reduce much faster. For me, I think that it is another factor that allows us to say the economy's standing on its own. It doesn't need these additional supports.
Yeah.
And so the energy in the marketplace is just less. And that's kind of how it plays out. I saw the segment you did with Jim, and trying to come up with a hard estimate about $100 billion. What does that translate? It's very difficult.
It's super hard.
But I think it's unambiguous that there's less energy that we are contributing to the marketplace, and that means that the ability for the economy to grow faster has just been weaker.